Hi, this is Steve All of the All Financial Group. Want to welcome everybody to the 6/15/2022 Town Hall meeting. Things are still, quote, crazy in the market. We had a little bit happen with the Federal Reserve today. I'll talk more about that during my part of this session. I wanted to go ahead and start out today. Again, thank you for all the referrals of families and friends. The company has grown exponentially over the last year. It's because people were willing to, quote, introduce us to their family and friends. I'll start out with WeathGuard warnings. I know a lot of people, those have come across. That's the problem with when we have a market like we've had. It's up one day, down the next, down a little bit, down. So what it does is it's going to kick a warning on. Then the next day when the market goes up, it kicks the warning off. And if the market drops the day after that, the warning goes back on again. So you've had a lot of those warnings. We do have the availability to turn those off if you prefer to have that, but I will not do that unless you want it shut off. What it does do in the old days when WeathGuard was originally put into place, it would automatically change your portfolio to a less aggressive portfolio. It does not do that anymore. The problem that it hit, the software that it was designed under said, if a WeathGuard is triggered, it cannot automatically move back into the market until it sees at least 3 months of positive returns. That means it can't do anything for 4 months. And the results due to the pandemic in 2020 were not good. So for your added peace of mind, no, it will not transfer you to a more conservative portfolio. It's more of a warning system today. If you have any questions, I've had probably 4 or 5 over the last 2 to 3 weeks of people calling to ask the questions. So if you have questions about WeathGuard, if you have questions about the notices that you've been receiving, yes, we are watching them. Yes, I do look at it, and I look to see what a client's total portfolio has been reduced by, so that if it's necessary, then we could call and make a change if we believe it to be necessary. So if you do have a WeathGuard and you do have questions about it, please don't hesitate to give the office a call. But reminder, it does not automatically move it to a more conservative portfolio. I'm going to come back at the end of the presentation. So I'm going to go ahead and turn it over. It looks like Deanna's ready to rock and roll. So we're going to go ahead and turn this next part of today's town hall over to Miss Deanna.
I found this morning, which I thought was great. And not to diminish what's really, that there are some real market threats going on right now. Right. And, we've got inflation that they're talking about. The Fed just announced their 75 basis point hike. So we're seeing more volatility again today, and we're getting calls on, am I going to be okay? And certainly we welcome those calls. Volatility in markets is not unusual, but we are experiencing more than what we've been used to over the last decade, and we seem like we're reiterating and repeating the same theme over and over again. But it's true. I mean, with the stimulus plan, we saw markets climb to new heights because of the easy money policies that we were experiencing. And now the Fed is having to reverse that path to control this runaway inflation. And it's important to remember that, markets cycle, and it's the volatility is what has historically enhanced long-term returns, because that volatility, that recalibration in a market is eliminating excesses in the market that build up during those bull runs. So what you're seeing right now, besides some other real pressures on the market, obviously, it's recalibrating. It's removing those excesses and waste in the market, and that actually reduces your risk over the long term. If the market did not remove those excesses over time, that's when we would experience a crash. And so these Fed movements are an attempt to try and control this inflation, and they would rather see a quick hit recession so that we can then recover rather than to peel this Band-Aid off very, very slowly. So a lot of these movements that the Fed is making is already being priced into the market. What we're hearing now is, are we at a bottom? Well, we don't know. You cannot with any certainty predict the market bottom, nor can you with any certainty time the market, but you want to take advantage of the opportunities that different markets present. Also, the opportunities that are going on currently with the volatility that we're seeing. We have an extremely resilient market. And one of the reasons I wanted to show this piece, this was printed in Business Week from 1979. They've been trying to live this headline down apparently ever since. They published Death of Equities when the Dow was under 3,000. And how inflation is destroying the market. The next piece is what I want you to pay attention to. This is where that was announced. And this is what happened to markets after they published that headline. Markets have always recovered and gone on to surpass previous highs. And these markets present opportunities for you to also maybe remove some of the pieces in your portfolio and rebalance if that's important. But here's another piece that I thought was interesting. Money is like a bar of soap. The more you handle it, the smaller it gets. So we feel like we've got to do something. Everybody's wanting to, what are we doing with my portfolio? Well, volatility was already factored into your overall plan. We have a piece of your portfolio that is taking advantage of the premiums that a volatile market will return to the investor over the long term. But you don't invest just for today, for 1 month, for 1 year, for 2 years. We're investing over your lifetime. So we have to have a portion in that market to stay ahead of inflation and to return those premiums to you, the investor, to maintain your buying power over time. Now, should you have some in short-term money? Yes, if you're taking income from a portfolio, you need that safety piece too. You may even need some cash for your immediate spending needs. So each individual portfolio is structured in those component parts to help you meet your long-term goals. But if you're only looking at that long-term piece that we have that's invested in the market, that's going crazy right now, you're going to get sick. And should we remove some of that and put it into safety? I can't say that for sure for you. For most of our clients, we've already done that. It's already factored into the plan. In fact, we carved out some of those gains and moved it into the safety piece during that bull run. Now, you might have too much in safety. It could be an opportunity to be buying back into the market. I'm not saying you should. I'm saying if you haven't looked at that allocation recently, maybe now is the time to do that. And so in our client reviews, we're looking at, do we need to be putting more into the market right now? Will it continue to go down? It could. We can't call the bottom, but we've already experienced a lot of market decline, and it could be an opportunity to increase your exposure in equities if that's appropriate for your plan. So I know it's disheartening to watch those numbers go up and down, but understand that there's a purpose for it, for some of the money, because we hope you're going to be around for a really long time. And we will need your dollar to go farther in year 5, year 10, year 15, year 20. We need that piece that's in the market and exposed so that we can have some of those premiums returned to you by way of gains. So I hope that helps put things in perspective, and I'll give it back to you guys.
Thank you, Miss Deanna. Mel, I'm going to go ahead and turn it over to you at this point.
Hi. I am going to share something that, as when I showed it to Steve, he said it's la la land. We'll see shortly. This is something I found today. And essentially, Mr. Sanders and about 15 other Democrats have proposed a change in the Social Security. They're calling it the Expansion Act. And I just hit a few of the highlights here to give you some ideas about what is being talked about. We get asked all the time, will Social Security go away? Will it still be here in the future? And the answer is no, it won't go away. And yes, it will be here. The question is in what form? Will it be for everyone or just everyone up to a certain income level? Will it be taxed more? Will it be paid out at later ages because of different life expectancy? So we expect it to change. And that discussion has been underway for a while, but this particular one caught my attention. Their proposal is to increase everybody's Social Security by $200 across the board. Just give everybody a raise. Okay. Also, the bill, existing Social Security COLAs, instead of using CPI or CPI core, they want to use CPI with a leaning toward healthcare and prescription drugs. That might actually make a lot of sense because the cost of living adjustments for retirees has actually been higher. Inflation has been higher for retirees for quite some time because of healthcare increases and cost. So that could make some sense, but it is another tax increase that is being proposed. Additionally, the bill would update Social Security minimum benefits to help low-income workers where it would be weighted. If they were roughly $17,000 a year in income, push them to, that'd be 125% of the poverty level for one person. Plus, it would allow children up to age 22 for a disabled recipient to move it up. So essentially, giving more Social Security for the lower income strata. They do that already. Social Security is weighted toward the bottom very heavily. They're just talking about increasing that. The other thing is the primary focus is, well, how are we going to get more taxes to help fund this thing? And right now, if you're a working person and you have income, earned income, you pay Social Security taxation on up to the first $147,000. So if you earn $250,000 a year or 200, you don't pay the Social Security tax above that number. Okay, the tax rate is currently 6.2% for you and your employer, or 12.4 total. If you're a self-employed person, and you pay all of that yourself because you are both of those two people. And let's see, the amendment to this wants to change that so that instead of stopping at 147, they will provide that same tax level up to $250,000 in income. Amend the payroll tax subject to all income over 250, excuse me. The bill sponsors estimate that 93% of Americans don't make more than 250, so it wouldn't apply to them. The ones that do are going to pay a lot of attention to this because it's going to get high really quick. Furthermore, the new bill would target the self-employed, business owners, and investors. The self-employed would see the same tax increase as the salaried people, meaning anything over 250 is going to get taxed. They're talking about moving that the investment income taxes from currently 3.8% up to 16.4%, which is a pretty huge increase for people who have a high investment income. In lieu of Social Security and Medicare taxes, business owners also would be hit with a new 12.4% Social Security tax on business income not already covered by payroll taxes. Now you've just said that every small business person in the country would have to pay for every $100,000 that's not part of payroll. They got to pay an extra $12,400 in Social Security, FICA, or one way or the other, on top of their income taxes. So you just took more than half of the income away. So that could be, what do you think happens when business owners suddenly have to pay 20, 30% more taxes? They're really not going to cut their income. So it gets passed right on down the line, and all those $200 increases you got in your Social Security just got blown out the window. Plus, because people want to make their incomes, and if they got to pay more tax, they're going to charge more rates. So now you're fighting inflation by raising interest rates again, or doing all kinds of other things. So it's a bit of a self-feeding animal. And if I do it over here, it's going to affect something over there. And again, as I'll quote Steve on this, this is La La Land. It's very unlikely that they would get this last portion of this ever passed. However, are they going to figure out a way to tax more for on income to fund Social Security? Yeah, I bet they will. It's just a matter of what they can get through and when, and how long it takes, and who's in charge when it's done. But I don't see any way around that. I think they're definitely going to do that. They're probably going to say that not just 85% of your Social Security is taxed. They're probably going to say 100% for everybody, not just the higher income earners or the business owners. That's a very likely scenario, in my opinion. They may come along and say the billionaires don't need their Social Security, but that's not going to, that wouldn't make a dent in the problem. If everybody that's got more than $10 million in the whole country stop getting their Social Security, it's probably not going to make a dent in this thing. So it's what's the old story that the best way to make money is be McDonald's and just raise your burgers by 3 cents or a nickel. It's not very much in and of itself, but when you sell a few billion of them, it's a lot. You're going to make more money that way than trying to sell burgers at $10,000 a piece. And you might get some people to buy them, but it's not going to be enough to fix the problem. So in order to fix the problem, they're probably going to tax us in some way or limit our benefits in some way. They're already doing that with Medicare by having IRMA and having your Medicare Part B being means tested. So since 2019, there have been probably 15 or 20 different little tax increases that have occurred, not only currently, but also in the future, and the changes in the Secure Act and what happens with Roths and 401ks. When you start doing financial planning and retirement planning, it is about a lot more than rates of return. Yes, our portfolios are, if we're allowed to design it the way we want to, we're going to have some of your money that is not subjected to the current market downturns. If you've been with us a while and you followed our normal programming, some of your money hasn't lost a nickel since all this stuff is going on. Some of it has. By mitigating that, the thing that Deanna said, which pocket do I spend out of if I'm spending? Market's up, I spend out of that one. Market's down, I go to the stable value because I don't want to spend the depressed asset. If I'm not spending the money, if I'm just letting it sit and grow, the markets are down right now. Now's a really good time to take the money out and put it over into the market. If the markets are really high, I want to pull some of the gains out and put it back on the stable side. So you have a platform that allows you to take the most advantage of upside and give you the most protection from the downside as that we can possibly build. But if you think you might need to rebalance or take another look at that, or if you've decided you didn't want to do one thing or the other, that it might be time to rethink those particular positions. So we're more than happy to talk to you about that at any time. That's mine.
Thank you very much, Mel. And then I don't usually use the illustrations and things of that nature, but with everything that's currently going on right now, I am going to use one today. And it's what I call the emotional roller coaster. You know, when markets start to go up, we go through the enthusiasm, the exhilaration. Remember back in the 90s when we go, God, as well as my portfolio is doing right now, I might retire 10 years early. You know, God, why do I need a financial advisor? Because of the fact that, you know, everything's going so well and we hit that euphoric state. Then we start to have the unease as the markets start to decline. Oh, I should have done something about it. Man, I can't believe I've done this again. Panic. Then all of a sudden, when despair gets in, we sell. And that's when you go with Warren Buffett. Warren Buffett says the problems with most individual investors is they usually buy high and sell low. And that's what causes the problems. Warren says when the blood's in the street, it's the time to be buying. So let's look at another headline. And I think Deanna hit it very well last week. Be careful of the headlines. They don't always mean what you think. I have done this market update for, I think, the last 4 market updates. The market was down between 3 to 5% almost every Wednesday for the last 4 months. So I always got to come on here right after the market had dropped. Well, it was up a little bit today, but is that a good thing? It was down 10% between Friday and Monday. So it's not really where it gets there. But the headlines coming out right now, consumer sentiment is as low as it's been for over 40 years. So over here to the right is where we're currently at. That 50% of the people are not real happy with what's going on. Well, I wonder why not. Inflation's at all-time high. We're paying $5 for gas. We have no clue what it's going to cost us when we go into a restaurant because everything is up. But I want you to look down here at the bottom of the subsequent 12-month returns of the S&P 500s when these types of consumer sentiments have had. 75, up 22.2% in the next 12 months. 1980, up 20. 1990, 29. 2003, 32. 2005, 14. 08, 22. 15. April of 2020, consumer sentiment, from that point forward, it went up 53%. So a lot of times when we start to see these things on the news, it's not necessarily completely bad news. I see things like what happened today was the fact that when we start to have the Fed finally jump in and do something that in Steve All's opinion, they should have done a year or a year and a half ago. There was no sense in us having interest rates as low as they were after the pandemic had moved forward. They needed to raise interest rates then, and they didn't. We gave out trillions of dollars, and now we're surprised people are quote, bidding on an asset that might not be there because all of the quote production was shut down. So we have this very high inflation right now. Some people were saying we only need 1/4 of a point or 1/2 a point. Well, then they started talking about the market will build in what it is. I think that 3/4 of a point was very good. I know that that sounds terrible, but for most of us that are currently in our senior years, we're not buying a lot of houses, so we're probably not going to refinance. We will buy cars and they will be a little bit more expensive because interest rates are going to go up. Most of our clients don't carry heavy credit card debt, so it's not going to hit them. It would be nice. I was talking with somebody today. How would you like it if that $10,000, $15,000, $20,000 you have sitting in your quote money market account made more than 0.05? You know, if we had something to put this quote safe money into that gave us some type of return, it shifted dollars into the market. A lot of our clients, when we started to look at it, I think Deanna mentioned it early, when we go through that sentiment type phase. Last year, markets were up. So what did we do? People came in for their reviews and we said, let's shift a part of your equities to the bond replacement. Let's put it in the fixed indexed annuity. Return a premium if we need to. 10-year contracts, but I can walk away with my principal in 3. To take some of the gains out of the market. And right now, when I have somebody come in for a review and I look at it and I say, okay, we've got that 10% free withdrawal from your annuity. I don't think you'd be willing to do it right now while the market's currently where it's at, but I do want to talk to you about repositioning that 10% back into the market. Why? So that way we have the philosophies of the Warren Buffetts and things of that nature. Buy low, sell high. Last year, a lot of clients, we sold high. We have not taken the declines that a lot of people have taken. Now is the time that we have to look at, is it time to start shifting dollars back towards the market? Do we have to do it all at one time? No, we don't. We can do it in a couple different phases. Remember, all of those fixed index annuities, some of them have 7, but most of them have a 10% free withdrawal. And we need to look at that to reposition ourselves to take advantage of the 25 to 30% decline that the overall market has taken to improve our positions in the market. So remember, be careful with your headlines. Be careful with the emotional roller coaster. If you've got questions, do not hesitate to give the office a call. We split up quite a bit now. I've taken days where, I haven't had a lot of them. I usually get on the average of maybe 1-2 calls a week. People asking questions about what's going on in the market, where's their portfolio at? And we sit down and I talk to them and I said, let's look at the whole picture, not just one. And by the end of the conversation, I believe everybody is back at peace. So please do not hesitate to give us a call at this time, because I think that's what we're here for. Our job is to guide you through your retirement so that it can be as comfortable as possible. So again, I want to thank everybody for all the referrals that you've given us. It's increased the size of the family. And I will take a quick note real quick. Oh, I got to move my fingers. I love my grandpa. I actually got to go to New York City and meet my daughter's baby. And I love being a grandpa. And I got home on Monday. Megan gives me a call and she goes, we got a problem. I said, what is it? She goes, well, Mary Violet was held almost all weekend long and she's crying when we sit her down on the couch. So I said, I did my job. I said, as a grandparent, I went and spoiled my granddaughter for 2.5 days and then gave her back to her parents. Perfect. So that they can take that. So my job is to spoil my grandkids. And I want to thank you all for being a part of that family. That's all I've got tonight.